what are some of the things that we should be avoiding? What are some of the things that kind of you cringe when you hear? And what are some of the messages that we need to double down on?
I'm super glad that you asked because I have the exact same feelings that you do. I'm grateful that there's some good marketers out there and just want to die with some of the language that they're choosing to use and some of the software that they choose to use, frankly. So one of my biggies is borrowing against cash value versus borrowing from. So a lot of people that don't truly understand the product will say you borrow from or you even take from your policy, and that's categorically inaccurate. So I have been on that bandwagon, I guess, for a long, long time. You borrow against your cash value. One of the other things I already brought up, which is the idea of borrowing against that cash value for income in your later life. That is a deal breaker. That used to work when we lived to 70 or 80 years old. We're going to have people living well past 100. There's no way a loan can sit on the books for that many years. So people need to stop the borrowing against for income in their later life and switch their thinking to the annuitization idea. Then in addition, when loans are talked about, I think they're spoken about incorrectly. One of the biggest things that is horribly inaccurate is this idea of simple versus compound interest. Mm-hmm. All loans are compound interest. It doesn't matter whether they come from the life insurance company against your cash value, or from a bank against your cash value, or from a bank against your home, or from a bank against nothing. It is a compound loan. Simple interest exists for one day only. So that's something that's quite frustrating. And then the other thing, and this is
let me unpack that. The reason it's compounding is because of opportunity cost. Each year that goes by, if you don't pay back your loan, there's a cost there. It's gonna, and everything compounds because over your lifetime. So it's either lost opportunity cost or a compounding loan. But there's no free lunch. And I do agree with you. The difference of, is this a simple loan versus a compounding loan? Well, all right, let's actually look at how the math works.
Yes.
And it's, yeah.
Yep. Life insurance loans work like just every other loan out there. The only difference is they charge interest only once a year at the beginning of the loan or at the anniversary date for whatever amount of loan is still there. And if you don't pay that interest, it gets added to the loan, hence the compounding nature. So yeah, very true. Let's see, there was one more thing, and you brought it up, really, this issue of opportunity cost, which breaks down to something called time value of money, which is an economic concept that's not always super easy for people to get their arms around. But actually listening to Todd Langford, the Truth Concepts creator, who's my husband, listening to him explain it has helped me explain it better. And that's that everything that we deal with exists in time. And one of his fun examples is, for people our age in our 50s, we used to ride around in the front seat of cars standing up as 2-year-olds without a seatbelt or a car seat or anything else. Yep. Well, people would get put in jail for that today. It's that story is taken out of time. And so a lot of these marketers that you're speaking of, when they make their analysis about things, they want to add a particular column of numbers up, but they don't affect that column of numbers with the passing of time. But then they tend to compare it to something that tends to be affected by the passing of time. So you have kind of one of those apples and beans comparison things, not even apples and oranges, right? Like it's so far apart, it's apples and beans. So that's the last thing that I would bring up. That just
do you have an example of that? Like, do you have an example of like what, like a real life example of what?
Yeah. So the most common one, let's take it out of the life insurance space for a minute. The most common one is the mortgage arena. So the 15-year mortgage proponents want to just add up the interest. Yeah. And then worse, they want to add it up over 15 years. Yeah. And then they compare it to a 30-year mortgage that they will add up the interest over 30 years. Yeah. So you've got a time differential. You can compare the whole deal over 15 years, but you've got to compare both loans over 15 years or both loans over 30 years. And then you've got to add that time value of money in there because the interest on a loan doesn't exist in a vacuum. It exists over time.